We often focus on the big numbers, revenue, profit, but for many businesses, the real story, and often a significant chunk of their assets, well, it lies in what they have on hand, their inventory. And
Absolutely.
understanding how that inventory is accounted for is it's absolutely key to truly grasping a company's financial health.
That's so true. And on this deep dive, we're going to really unpack the world of inventory accounting, specifically how it's treated under International Financial Reporting Standards,
What?
or IFRS.
IFRS.
And we'll draw some comparisons to US GAAP as well,
Yeah.
all based on this inventories v2.pdf document we've been looking at.
Exactly. And look, these aren't just abstract rules for accountants, are they? They fundamentally shape how a company looks on paper
Hmm.
and the decisions they make about their operations and ultimately how we, assess their value.
Right.
So we're aiming to highlight not just the similarities, but those really interesting differences between IFRS and GAAP.
And just to set the stage a bit, when we talk about inventory under IFRS, we're covering quite a bit, actually.
Yeah.
This includes your finished goods ready to be sold, the raw materials and components still in the production process.
Work in progress. Yes,
Exactly. And even the supplies used up in making those goods or delivering services. And interestingly, IFRS also specifically includes tangible items produced for resale, like, say, certain software products.
Huh. Software too. So a pretty comprehensive definition then.
It is.
Our goal today is to really get to the heart of how IFRS deals with all of this and to spotlight some of those fascinating points where it kind of veers away from US GAAP. Okay, so where should we dive in first?
Well, I think a logical starting point is the core principle. It guides inventory valuation under both IFRS and GAAP.
Okay.
And that's the idea that inventories are generally measured at the lower of their cost and their net realizable value.
Lower of cost and net realizable value. Okay, that sounds fairly intuitive, right? You don't want to overstate the value of something if you think you're going to sell it for less than you put into it.
Precisely.
So let's break down what cost actually means under IFRS. What's included?
Right. So under IFRS, cost is, well, broadly defined. It's basically all the expenses directly tied to bringing the inventory to its current location and making it ready for sale.
So purchase price, obviously.
Purchase price, yes, but also things like import duties, transportation, handling, other directly related costs.
Okay.
And what's particularly interesting, I think, is that IFRS explicitly includes costs associated with dismantling and restoring an asset.
Really?
Yeah, if those costs are a direct result of producing the inventory.
Wow. Okay. That's a really insightful detail, factoring in potential future environmental obligations sort of into the present cost of the goods.
Exactly.
Now, how does IFRS define the other side of that equation, net realizable value, or NRV?
Right, NRV. It's the estimated price you'd expect to get for the inventory, in the normal course of business.
Okay.
Minus the estimated costs needed to complete the production of that inventory.
Ah, the completion costs.
And the estimated cost to actually make the sale. So think marketing, distribution, that kind of thing.
Right. So cost is your investment, and net realizable value is your realistic anticipated return, basically.
That's a good way to put it.
Now, you mentioned earlier that there's maybe a key difference in how GAAP approaches this compared to IFRS.
Yes, there is. While GAAP also operates under the lower of cost and net realizable value principle, its definitions for both cost and net realizable value,
Yeah,
well, they tend to be more prescriptive.
more rules-based.
Kinda, yeah.
No?
More detailed guidance compared to the more principles-based approach you see in IFRS.
Okay.
And this difference in the level of specificity, well, it can sometimes lead to variations in how similar situations are actually accounted for in practice.
That's a crucial distinction to keep in mind, definitely. Now, let's move on to how companies actually track the cost of their inventory flows. We know there are methods like FIFO and LIFO. What cost formulas are acceptable under IFRS?
Okay, so under IFRS, the permitted cost formulas are FIFO, which is first in, first out.
Right, the first ones bought are assumed to be the first ones sold,
Exactly. And the other one is the weighted average cost method.
which averages out the cost over time.
Yeah, it recalculates an average cost after each purchase, essentially smoothing out price fluctuations.
Okay, so those are fairly standard methods, but I seem to remember there being a significant divergence when it comes to the LIFO method, last in, first out.
Ah, yes, LIFO. That's a really key difference. Under IFRS, the last in, first out, or LIFO method is explicitly prohibited.
Prohibited or?
Completely banned. LIFO, as you know, assumes that the last units purchased are the first ones sold, and this can significantly impact a company's reported cost of goods sold. and, consequently, their profit.
Especially when prices are going up or down a lot.
Precisely, particularly during periods of inflation or deflation.
Interesting. So even if LIFO might seem to better reflect the actual physical flow of goods for a particular company, they just can't use it if they're reporting under IFRS.
That's correct. IFRS favors methods like FIFO or weighted average, which are generally seen as more closely aligning with the actual physical movement of inventory for many businesses, or at least providing a smoother average cost.
But is there any other flexibility?
Well, IFRS does allow for the use of other cost formulas, like the standard cost method or the retail method. But there's a condition. They can only be used if these methods provide a reasonable approximation of the actual costs calculated using FIFO or weighted average.
Okay, so some flexibility in arriving at a cost figure, maybe for practical reasons, but a definite ban on LIFO itself. Got it.
Right.
Now, what happens when the market value of inventory drops below its recorded cost? We touched on net realizable value earlier.
Yeah, so both IFRS and GAAP require companies to write down the value of their inventory. If the NRV falls below the original cost, you have to recognize that loss.
Makes sense. You wouldn't want to keep an asset on your books at a value you can no longer realistically expect to recover.
Exactly. It acknowledges the reduction in the economic benefit you expect from that inventory.
But I understand there's a pretty important difference in how IFRS and GAAP handle these write-downs going forward, right, in the future.
You're absolutely right. This is a really notable point of divergence. IFRS actually permits the reversal of a previous write-down.
Oh, reversal.
Yes, if the circumstances that originally led to the impairment no longer exist or have improved. For instance, if selling prices recover significantly.
Okay.
A company can then increase the carrying value of the inventory again, but, and this is important, only up to the amount of the original write-down. You can't write it up higher than its original cost.
Okay, so if you initially reduce the value by, say, $10,000 due to a market downturn, and then the market rebounds strongly, you could potentially increase its value back by up to that $10,000 on your books under IFRS. How does GAAP treat this? Is it different?
It's very different. Under GAAP, inventory write-downs are generally considered permanent. They are not reversed.
Never.
Well, generally not. Once an inventory item's value is reduced, that lower value typically becomes the new cost basis.
I see.
And it's maintained at that lower level even if market conditions subsequently improve. It definitely reflects a more conservative stance in GAAP.
Yeah, seems much more conservative.
You could say GAAP prioritizes, maybe, reliability and preventing potential overstatement of assets, whereas IFRS allows for a bit more flexibility to reflect improved economic circumstances.
That's a really significant difference, isn't it? It could certainly paint different pictures of a company's financial situation depending on which accounting standards they use, especially in industries with, say, volatile pricing.
Absolutely. Big commodities, fashion, tech.
Yeah.
It could make a real difference.
Yeah. Now, the document also outlines some specific categories that are excluded from IFRS's main inventory accounting standard, IAS 2. What are those?
Yes, there are a few important scope exclusions. First, financial instruments, things like stocks, bonds, derivatives. They're covered under completely separate IFRS standards, like IFRS 9.
Okay, that makes sense. What else?
Second, biological assets related to agricultural activities, think living animals or plants, and also agricultural produce at the point of harvest. These fall under a different standard, IFRS 41 agriculture.
Right. Specialized assets often have their own specific accounting rules tailored to their unique characteristics. It makes sense they wouldn't fit neatly into the general inventory rules. Anything else on that exclusion list?
Yes, a couple more. Interestingly, IFRS also excludes inventories held by producers of agricultural and forestry products, agricultural produce after it's been harvested, and mineral products. But there's a catch.
Oh.
This exclusion only applies if these inventories are measured at net realizable value, and crucially, if this practice is already well established within those particular industries.
So it carves out an exception for existing industry practices where NRV accounting is the norm.
Exactly. And lastly, commodity broker traders who measure their inventories at fair value, less the cost to sell, are also outside the scope of IAS 2.
Okay, so IFRS makes some specific exceptions, particularly for sectors where valuing inventory at something closer to market value, like NRV or fair value less cost to sell, is already common practice.
Well, it seems to be the rationale, yes.
Yeah. Okay. Now, let's maybe delve a bit deeper into what is included in the cost of inventory under IFRS. It sounds like it encompasses more than just the initial purchase price we touched on earlier.
Absolutely. As we sort of mentioned, the standard breaks it down into three main components: costs of purchase, costs of conversion, and any other costs incurred to bring the inventory to its present location and condition, basically ready for sale.
Okay, let's break down each of those. Costs of purchase seems fairly straightforward, but could you give us some specific examples?
Certainly, costs of purchase, as we said, include the initial purchase price itself, but also things like import duties, any non-refundable taxes paid,
Okay.
shipping and handling expenses, and any other costs directly attributable to acquiring the finished goods, materials, or supplies.
And this is net of discount.
Yes, that's important. It's after deducting any trade discounts, rebates, and similar price reductions you might receive.
Okay, so it's really the actual net cash or equivalent expense incurred to get the goods in the door ready and available. Now, cost of conversion sounds like it would primarily apply to, say, manufacturing businesses, right? What does that involve?
Exactly. Costs of conversion are the expenses incurred in transforming raw materials into finished products. This primarily includes direct labor costs, the wages of the people actually working on the products.
Makes sense.
And it also includes production overheads. These overheads can be fixed, like depreciation of factory equipment, factory rent,
Right.
or they can be variable, like the cost of indirect materials or indirect labor, or maybe factory utilities that fluctuate with production levels.
Okay, and how are those overheads assigned to products?
Well, IFRS is quite specific here. It says that the allocation of fixed production overheads should be based on the normal operating capacity of the production facilities.
Normal capacity,
Right.
not actual production.
Right. Normal capacity is the production expected to be achieved on average over a number of periods or seasons under normal circumstances, allowing for planned maintenance. It prevents companies from, say, allocating huge amounts of fixed overhead per unit if production drops significantly in one period.
Ah, okay. So it prevents companies from maybe artificially inflating their inventory costs just because they had a slow month in the factory? That's an interesting point.
It aims for a more consistent cost allocation, yes.
And what about these other costs that can be included in inventory? What falls under that category?
Other costs are really those necessary costs,
Yeah.
beyond purchase and conversion, to bring the inventory to its present location and condition for sale. A good example might be non-production overheads, like maybe design costs for products specifically created for a particular customer.
I see.
The key criterion is always, was this cost necessary to get the inventory into its current state and location, ready to be sold?
Got it. Now, are there any costs that IFRS specifically says cannot be included in the cost of inventory? What gets excluded?
Yes. The standard is quite clear on several exclusions. These include things like abnormal amounts of wasted materials, labor, or other production costs, like from an unexpected factory shutdown.
Okay, so inefficiencies aren't capitalized.
Right. Also, storage costs are generally excluded unless those costs are an essential part of the production process itself before a further production stage.
So warehousing finished goods usually wouldn't count.
Typically not, no. That's usually considered an expense when incurred. Also excluded are administrative overheads that don't directly contribute to bringing inventories to their present condition.
Like general corporate admin.
Exactly. And finally, selling costs, marketing, sales commissions, distribution to customers, those are always excluded from inventory cost and recognized as expenses.
Okay, that helps to clearly define the boundaries of what can be capitalized as part of inventory cost versus what needs to be expensed immediately. Now, we briefly mentioned agricultural produce earlier and how it's treated differently at harvest. Could you elaborate on that?
That's correct. It's a specific carve-out in IAS 41, the agriculture standard, but it impacts how inventory accounting starts for these items. Under IFRS, agricultural produce that's harvested from biological assets like wool from sheep or apples from trees is measured initially at its fair value less any estimated cost to sell, right at the point of harvest.
Fair value, less cost to sell, not historical cost.
Correct. It's a significant departure from the historical cost basis we've been mainly discussing for other types of inventory. It reflects the idea that there's often an active market for these harvested goods, and their value is more relevantly measured at current market prices at that point.
So the moment it's harvested, its value on the books is essentially marked to its current market value net of selling expenses.
Precisely. And importantly, this fair value that's established at the point of harvest then becomes the deemed cost for the purposes of applying the main inventory standard, IAS2, to that agricultural produce in subsequent periods.
Ah, I see.
So while the initial valuation is at fair value less cost to sell, any later accounting for that inventory follows the usual lower of cost, which is now that initial fair value, and net realizable value principle.
That's a really interesting hybrid approach, isn't it? It acknowledges the unique biological transformation and market dynamics of agricultural production, but then folds it back into the general inventory framework.
It does. It's quite specific.
What about service providers? You mentioned them briefly earlier. They don't really have tangible inventory in the traditional sense, do they? How does IFRS account for their inventory, so to speak?
That's a great question. For service providers, inventory under IAS 2 is primarily understood as the costs incurred in providing those services that haven't yet been recognized as revenue. Think of it like work in progress for services.
Okay.
This mainly includes the costs of labor and other personnel costs for staff directly engaged in delivering the services, including any necessary supervisory staff.
Right.
And it can also include any overhead costs that can be directly attributed to providing those specific services. So it's essentially about accumulating the costs associated with services that are still in progress or haven't been billed yet.
So it's more akin to tracking the cost of uncompleted work in a service industry context.
Exactly, measured at the lower of those accumulated costs and the net realizable value, which in this case would typically be the expected revenue less any further costs to complete and sell the service.
Okay, that makes sense. Finally, wrapping this up from a reporting perspective, how are inventories actually presented in a company's financial statements under IFRS? Where would we typically find them?
Sure. Under IFRS accounting standards, inventories are required to be presented as a current asset.
Current asset, okay.
You'll find them on the statement of financial position, which most people still call the balance sheet. This classification as current indicates that these are assets the company expects to convert into cash, usually by selling them within its normal operating cycle, typically within 1 year.
And what about the expense side? When they get sold?
Right. The cost of the inventories that are actually sold during a specific accounting period is recognized as an expense in that period. This usually appears on the statement of profit or loss, the income statement, under the line item cost of goods sold, or sometimes cost of sales.
Got it. Okay, that gives us a really comprehensive overview of how inventory is accounted for under IFRS based on our source document. So just to quickly recap the key takeaways for everyone listening.
Yeah, let's summarize.
It's fundamentally about the lower of cost and net realizable value,
Right.
with a specific definition of cost under IFRS that includes purchase, conversion, and other necessary costs, and can even include things like future decommissioning costs linked to production.
That's a key point.
The acceptable cost flow formulas are FIFO and weighted average. Crucially, LIFO is completely off the table under IFRS.
Big difference from GAAP there.
Definitely. And write-downs to net realizable value. Well, under IFRS, they can potentially be reversed if market conditions improve, which generally isn't the case with US GAAP.
Another significant divergence. More conservatism in GAAP on that one.
Yeah. And we noted specific scope exclusions for things like financial instruments and most biological assets at harvest, with agricultural produce getting that initial fair value less costs to sell assessment at harvest, which then becomes its cost.
Exactly. Those nuances are important.
So understanding these details, particularly where IFRS differs from a framework like US GAAP, is really essential, isn't it? Especially for anyone looking to get an accurate understanding of a company's financial health and performance when dealing with multinational corporations that might be reporting under IFRS or have subsidiaries doing so.
Absolutely critical. You need to know which rules they're playing by to interpret the numbers correctly.
It really underscores how accounting standards, while they might seem technical or, dare I say, dry sometimes,
Sometimes.
they have a very real impact on how we interpret a company's financial story and its value.
Couldn't agree more.
So here's a final thought for you, our listeners, to mull over. Considering these differences we've discussed in inventory accounting between IFRS and GAAP, especially LIFO prohibition and write-down reversals, how might this impact your analysis when you're evaluating the financial statements of a global company? Maybe one with subsidiaries reporting under different standards. What further questions does this comparison spark for you about the complexities, maybe even the compromises, inherent in global accounting practices? Definitely something to ponder as you continue your own exploration of the fascinating world of financial reporting and analysis.